Do you know the signals that many would say shouted warning signs prior to each of the bubbles that we've experienced through history, whether it be tulip mania, the dot-com bubble, or more recently, the 2008 housing crisis? Today, I'm going to cover these common themes in addition to other things that I've seen play out over time as we've watched various bubbles form across different sectors of the markets. In addition, I'm going to review some of the situations that you should be aware of and take into account when considering how to rebalance and understand your overall portfolio and financial plan. From dialing down personal leverage, to building cash reserves, to stress testing your portfolio and gaining a better understanding of how it could react during different situations. And before I jump in, while it's not always the most obvious sign that a bubble could be forming, it's also particularly hard when you're riding the wave to have the discipline to jump off and protect yourself. I would consider one of the most dangerous slogans that I've heard over the years of doing this is that this time is different. So let's unpack why what I would consider to be very educated people might feel that way time and time again, and why they could ignore all the signs that are flashing in front of them. First and foremost, if these signs are so obvious, how is it that educated, seasoned investors tend to miss them time and time again? The short answer, in my experience at least, is that they don't feel like bubbles when they're on the way up. The stories sound reasonable, the people around you are happy, and the gains in your portfolio make it easy to justify that things might just be going well. But that's exactly why I feel in multiple instances, this could lead to a trap. Prices go up, your portfolio achieves gains, and everything feels just all right. However, the underlying risk of the markets, and maybe even your portfolio, could be rising as those stock prices increase as well. You see, in my observation, overconfidence tends to come in streaks. Your portfolio increases, things are feeling good, and you might end up ignoring all of the signs in front of you that could prove danger ahead. At some point, social proof even kicks in. Whether it's your colleague talking about how much money they've made, or a family member asking you why you're not buying more. The more these voices repeat the same upbeat lines, the harder it can become to sit still. Because of course, you have the fear of being the only one at the table not making money. And specifically in pre-retirees, I see this pressure can become overwhelming. Watching the same news headlines over and over with the same bullish thesis, as well as stock prices moving higher and everyone around you cheering for more money. And some of these retirees, for instance, aren't even necessarily sitting in cash. They could end up owning blue chip stocks that might be chugging along just fine. However, they're not performing like the hot names or hot sectors of the week. The fear then shifts at this stage in the game, and a mindset forms that rather than losing money, they're fearful of missing out of the next leg up. And what this could in turn cause is taking things from a diversified portfolio into a much more concentrated risky situation as you're getting closer to retirement. I've said it before, and I'll say it again. If you're ever feeling that it could be more costly to not take action and needing to jump in and do something, that could be the perfect timing to take pause, reset, and consider what's going on around you. Now let's come back down to reality for a moment. And if you've ever felt any of those feelings, I'm specifically talking to you. The reality is that emotion can be a very powerful thing, especially when it comes to investing, and it does not always lead to the best decision making. So instead of using emotion, I prefer to stay regimented. And I have a system that uses the following 3 red flags when looking for a potential bubble. Red flag number 1 can be deceiving, but impactful nonetheless. Have you ever taken a minute not only to think about the assets you own, but what type of debt is behind them? And what I'm speaking about specifically is leverage, which can turn issues into complete disasters. Leverage is quite simple to define, but it can be very hard to live with. And very simply put, it's the process of using money and or borrowing to purchase more of an asset. In this instance, in particular, a stock. If asset prices rise, gains could look bigger. However, you're using someone else's money to own the shares. And on the flip side, when you start experiencing losses, they can happen almost twice as fast as a regular loss would occur had you not had leverage in your portfolio to begin with. Let me give you an example. If you own $100,000 worth of a stock, and that stock dips 10%, you're down at the current time $10,000. It might hurt or it might not, but some folks in theory can probably wait out the volatility over time. On the other hand, if you bought the same $100,000 worth of stock, whereby 50% of that, or $50,000, is with your money, and the other 50%, or $50,000, is with a loan via margin from the brokerage, if you experience a 10% downturn, you'll actually end up seeing your value decrease by 20%. Push that decline a little further, and next thing you know, you could be getting a call from the broker-dealer in a forced sale or raise of capital to make the account whole. Your plan more than likely was not to sell the stock when it was low. However, through the use of leverage, even small declines can turn into urgent decisions. And urgent decisions don't always align with long-term planning. And as I mentioned earlier, we've seen this occur time and time again, whether it be tulip mania, or the dot-com bubble, or even the '08 housing crisis. Leverage, in one form or another, has been used in each of these cases and ended up causing systemic breakdowns. When thinking about tulip mania, investors weren't just buying and selling bulbs. They were actually collateralizing assets as a way to be able to buy these bulbs. When buyers thinned out and liquidity vanished, it wasn't a gentle drift downward. Unfortunately, contract disputes arose, and the collateral for these bulbs couldn't be sold fast enough. The asset in this particular story was a tulip bulb, which ended up leading to heightened volatility and leveraged disaster. The core mechanism I focus on here is that when liquidity dries up, forced sales can occur, which drive prices lower, which ends up forming a feedback loop. It could start with something as small as reevaluation of risk by lenders, a slight change in credit, or even a pause in new issuance. And by the time it shows up in prices, financing conditions more than likely have already turned. So, the practical rule that I follow here is avoid using assets as collateral to purchase more potentially volatile assets. And there will always be folks out there who do choose to go this route, whether it be retail investors or institutions. However, for myself personally, I don't understand or want this type of situation in my overall picture. Next, let's flip the page to red flag number 2, which is innovation hype, something that can absolutely hide basic math. When a new technology promises the future, how do you know if you're investing or just purely speculating? And the key here, that it's more than just a press release or some crazy story or thought of something that could occur in the future if everything goes right. It boils down to dollars and cents. Innovation hype tends to occur when real breakthroughs pair with aggressive timelines, when years shrink to quarters, quarters to months, and anything we're focusing on is future projections. And while the product might work, and even potentially scale very easily, sometimes stocks end up leaning on the side where all things would have to go right, including perfect execution, access to cheap capital, and potential competitors that just simply decide to stand on the sideline. I like to identify patterns, and this concept takes the following into account: a believable leap in capability, a path to early profitability, and a stock price that bakes both of these things in. And the first part could be true, but the second part is where I feel that investors have a little bit of trouble. Regardless of a company's future prospects for growth, there are other situations and hurdles that could occur over time natural for the course of business, which could include things like hiring bottlenecks, supply chain issues, or even just the cost of capital increasing over time. And if a stock price essentially expects completely flawless execution, any little minor glitch could cause a serious downturn in the stock. This year alone, I think we've seen this in many instances in sectors and themes, and we're actually still watching it unfold in real time. Take some of the quantum high flyer names, for instance. These companies promised game-changing breakthroughs at warp speed. And at the end of the day, I think investors are starting to rethink the story. Initially, upon all of the hype, it seemed like investors felt that years of R&D would end up being skipped over and immediately experiencing world-changing technology produced by these quantum companies. In the same breath, we've also seen that in some of the smaller data center-oriented names, or even the nuclear energy companies. If you've read anything in the news over the last year or so, you might have seen at some point that the grid could come under stress. So, kind of ends up being a believable story that making a shift into using nuclear energy could be a great breakthrough and driver of the economy. So when you couple that hype around companies that promise incredible breakthroughs with the fear of missing out, where investors as a whole could want to hit on the next biggest thing, you could end up in serious disaster. And that brings me to my next red flag, which is analyzing volatility of your portfolio. Volatility is a measure that tells us how quickly and how far prices can move. It's also the day-to-day or week-to-week swings that could end up stretching your nerves quite thin. And from what I've seen over the years, is that as we're reaching peaks in certain stock prices or markets in general, underlying volatility can increase as well. And that is because in theory, risks could be growing below the surface. Liquidity, in essence, becomes thin at the edges. Traders pile into the same names. And any news, no matter how slight it might be, could send a stock soaring to the upside or tanking to nothing. Defined simply, volatility is the speed and size of price change over time. Calm markets tend to move in smaller bands, while volatile markets tend to lurch. Late in a cycle, good news could end up pulling expectations forward further, and you could end up seeing a higher movement in stock price. However, on the flip side, even a minor hiccup in a company's earnings or news could end up pulling the stock down as investors try to figure out how to reprice what's already baked into the stock. And these mechanisms don't necessarily require a crash to start them. In fact, many times they're often brewing below the surface while the news out there is still kind of good. So now that we've looked at these three themes, what are some of the concepts that you can consider when trying to evaluate your overall portfolio and how you stand? First and foremost, you do not need any fancy tools. And I also want to make clear this is not about predicting a top. It's more so about building awareness and understanding where any weak links could lie in your portfolio and having the ability or the idea and a plan to remove them. First, consider your relationship with leverage and what it means to you. Are you borrowing money in any capacity to purchase more securities, whether it be via margin or utilizing products like options or levered ETFs? Having an understanding of the leverage in your portfolio is something to consider. Next, have a full understanding of your near-term and mid-term investment and cash planning. Do you have 12 to 24 months of withdrawal room baked into your portfolio whereby any excess volatility wouldn't necessarily hinder this plan? Then, determine your cash reserves. How much cash would make you feel comfortable? What we see typically is that investors on the conservative end might opt to keep between 3 to 6 months of expenses in cash. Next, shift gears a little bit and understand, are you holding any companies that are trading high and don't necessarily earn a profit yet? And although I don't tend to get involved in these names myself, I have seen other investors over time who do have certain strict parameters as to how much exposure they'll allow in their portfolio. If you do prefer to own these names, do you have any strict guidelines as far as capping out the maximum size of your position? And here is where the stress testing of the portfolio could be something to think about. Take your current allocation and model a 25 to 35% decline and added volatility. Think about how that makes you feel. The bottom line is, while there's no right or wrong answer, and I'm certainly not here to preach on how your allocation should work, I can say that what I've seen over time end up in relatively positive outcomes more often than not is using a rules-based approach. And if you're considering rebalancing your portfolio prior to year end, but you don't know where to start, check out our next video here.